Hello everyone, I'm William and this is Abraham from PropertySold.ca. Today we're going to talk about home equity lines of credit, or HELOC, sometimes they're known as. Abraham, do you want to walk everyone through a home equity line of credit?
Yeah, a home equity line of credit is one of the borrowing instruments that you can apply for and be approved for in the marketplace. We're talking the ones that you know about, of course, are lines of credits, credit cards, loans, and lines of credits, but unsecured lines of credits. A HELOC, or in the marketplace, it has many different names: home line, matrix mortgage. What they are essentially are secured lines of credits. So the bank has the security of the house behind it, so that means they can offer lower rates than what they can offer on unsecured debt. The Visa cards, the lines of credits, and the loans.
So this is different than your mortgage, and it's different than your credit card and your car payment and stuff like that.
It's right in between, actually, which is funny. It's a product that came in the marketplace because everyone's looking for a cheaper vehicle to put their debts into, something that's going to cost them less interest over time.
Okay.
So the bank says, look, we can do a secure line of credit. We will take the equity in your home after you pay down your mortgage to a specific amount, and we can secure a line of credit in there, starting as low as $1, and as you pay down your mortgage, that line of credit will increase because there's more room as you pay down your mortgage. And of course, depending on the equity in your home, you can get the line of credit up to 80% sometimes, or even 65% of the value of your house. And of course, a lot of people have seen their house prices increase over the last 4 years, 5 years, dramatically. 7 years, I think, almost double in some cases. Yeah. So there's a lot of equity out there. And if you're borrowing right now a loan, personal loan, car loan, line of credit, or credit card, you're talking interest rates from 5% to 22%, depending on the product. Car loans, 7%. Visa cards, 22, 19. The interest rates are insane. If you're ever looking to lower your lending interest rates, a secure line of credit is definitely the way to go, because we're talking about prime plus 1 or prime plus a half on a secure line of credit, where everything else is much higher. Unsecured line of credit, prime plus 2, and it just goes up from there, as I said, up to 29% even on some credit cards.
So you could have borrowed just straight money from the bank unsecured at 8%.
Yep.
You could have a car loan at 5%.
Yep.
You could have money in your credit cards at 23%. Yep. And you would basically bundle those and borrow that total amount, but have it secured against your home to get a lower rate.
Exactly. And that's where the secure line of credit comes in: the HELOC, the home line, the matrix mortgage, whatever it's called with the different lenders. And it's really a way of reducing how much interest you're paying out each month. And if you have the equity in your home to do it, great, there it is. And not only that, a lot of people will use that money for renovation on their house. The only place, if you don't have the money yourself to go and put it down on your renovation, you're going to look at maybe a personal loan or a line of credit, and you're talking interest rates that are much higher. If you're going to increase the value of your home, you might as well look into a line of credit secured against the house. Use that money to put in your home. Not only does your property value go up, you're borrowing the money at the cheapest possible interest rate available, and so therefore you're winning in both ways that way. Your home's going up and you're borrowing the money the cheapest. That's really the cheapest way to do it. Okay,
so if you don't have a car loan and all those other debts, but you want to put in a new kitchen or a new swimming pool, and it's going to cost you $30,000. Yeah. The home equity line of credit would be the best way to do it, because that's the cheapest way to borrow it.
Yeah, cheapest way to borrow the money. And so that's why it's becoming more popular. People are looking to reduce how much they're paying in interest, because it gets ridiculous. When you really look at the numbers, every bill that comes in, the interest rate that you're paying out each month. So one way to do it: consolidate it into one, put it into that secured line of credit, and pay the lowest possible interest rate. And then again, where am I going to find the money to do my renovation? Do I have to borrow it? Well, borrow it in the cheapest possible manner from a secure line of credit. So yeah, in those two cases, it's definitely the best way to go.
And a mortgage agent can do that for you?
Definitely. We have access to all the lenders. We can set up this product for you and give you, of course, all the details depending on your unique situation, how much you can be approved for, what are going to be the costs. And this is an interest-only type of loan as well. You're not paying principal interest. You're paying interest only, just like your regular line of credit.
Okay.
Except that it's got a lower interest rate. So,
excellent.
Yeah.
Thank you very much, Abraham.
Thank you, guys.